All right, so listen, everybody that's joined, my name is Michael Guyette, publisher of the Lead Lag Report. Special guest for the hour is Callum Thomas. I had Callum on several months ago and had him on our other show that we do occasionally. Now that I'm doing these as edited podcasts on my YouTube channel, wanted to have him back, especially given the broader insanity that's been going on across all markets. So what I like about Callum is that he's able to kind of look at things without the narratives, which I think people often fall for, which we'll talk about. But Callum, before we talk about the current environment, just introduce yourself to the audience as far as your background, who you are, and what you do.
Yeah, so I currently run a research firm called Top Down Charts, which is basically looking at the world and trying to figure out where the economy's going, where the markets are going, and come up with actual meaningful recommendations around asset allocation. So it's mostly aimed at fund managers, but I did recently launch a entry-level version, so there is that to take a look at. But before that, I was in funds management, so on the buy side there, basically looking at the same thing, so multi-asset, pretty much go anywhere, but sort of a mix of funds really, but a little bit of bread and butter asset allocation, but as well as some sort of interesting stuff around the edges. So and I did that for about 10 years, did a bit of little bits and pieces of education, but the real education happened when I was at the desk looking at the charts and reading the reports and just seeing things unfold.
Okay, so I have said very publicly for the last several months that this environment is, for lack of a better way of saying it, complete and utter hell. And if you're a stock-only investor, you would think, well, this just looks like a standard run-of-the-mill correction. The problem is, of course, that we have never really had a correction in stocks where you have such a severe sell-off in bonds at the same time. And that has all kinds of implications on asset allocation and perhaps with a lag, the stock market itself. Talk through the various things that you're looking at from a macro perspective as you think about the bond market first here, because the most frustrating and difficult thing about the way this has played out is that you have not had treasuries be the risk-off asset the way historically it tends to be when you see uncertainty in equities.
I mean, looking at the year-to-date returns, it's basically only cash and commodities that have done positive returns, and everything else is down almost by about the same amount, which is quite challenging for sort of the traditional asset allocation portfolios, which are like, okay, I'm going to own some stocks, I'm going to own some bonds, and when stocks go down, bonds will probably go up, because usually what's driving that is that the economy turns down, and so then bonds tend to rally in that situation, and stocks, obviously would fall usually because the earnings outlook gets downgraded and so on and so forth. So, but this time it's it's nothing like anything in the last 40 years. And I guess there's a few sort of problems with this too. Like, if you kind of educated your either your mental models or your mathematical models on the last 20 years, you'd be completely wrong-footed in this type of environment, because I think it is truly a unique environment. This is going to be one of those periods where we're going to be looking back 10, 20 years from now saying, is it like the 2020s? But it's, I think, probably one parallel, or the closest, is the 70s. And unfortunately, there's a lot of data series that don't actually go back to that period. Like you'll see, the bond drawdown charts that say, this is the worst drawdown on record, but we don't have, unfortunately, don't have the data back to the 70s. And I guess it's the challenging thing too is that the starting point was yields were basically nothing, and if you have a big loss, at least you have, when yields were high single digits, even double digits in the 70s, 80s, at least you had a bit of a yield cushion to eat into. This time there wasn't that, and so I think it's more of a bonds are focused on inflation, just repricing against the sort of long-term inflation aspect, and also against what the Fed is doing. Given that equities were kind of propped up by low bonds, then that's kind of taken the pillars of support away from equities as well.
So essentially, you mentioned the data set, right? Because the University of Chicago has something called the Center for Research and Security Prices, CRISP. And if you look at a lot of these kind of historical research studies that look at different anomalies in prior decades, a lot of them reference the CRISP data set, CRSP data set. And I've often heard that line that we haven't seen anything like this in the last 40 years. And to your point, because oftentimes when people look at the data, they don't go beyond or can't see beyond the past 40 years. But if you look at that historical reconstructed CRISP data, you'd find that even the 70s and going back to even periods like the 20s, 30s, 40s, you would not have such a strange coincident behavior where you have a drawdown in equities and then a drawdown in treasuries in particular at the same time. And I'm saying that very purposely because if you look at the 10-year index that CRSP, that is from the University of Chicago, what you find is that even in the 70s, which a lot of people will reference in terms of this being the closest parallel to, you did not have this unrelenting sequence of declines where yields are rising, 10-year Treasury total return indices are losing money at the exact same in the exact same path, right, as equities. Now, I mention all that because whenever you do any kind of research, as you know, that's trying to identify what's happening in the current environment and what could happen in the future, the presumption is that the historical data set has something like what we've seen, some parallel. And to your point, this is really one of those unique situations where nothing in the history books would have told us it could have played out exactly like this. Now, hindsight bias, of course, you can argue that, listen, inflation was due to come. You were going to have this kind of sell off in bonds, but it's that interaction with stocks, which I think is what's not really thought through by most investors. Now, you talk about asset allocation. You mentioned cash and commodities. Talk about how you think about the role of cash for a moment. If it's something that should be considered its own separate asset class, or if it's more a residual of the investment process.
Yeah, that's a good question. I mean, I was thinking about this the other day. Like, you know, how do you come up with, say, a valuation indicator for cash? Where because it's relatively straightforward to do that for the others like commodities, equities, bonds, REITs, credit. I mean, anything with a price that goes kind of up and down, it's relatively easy to put some form of valuation anchor in place. But for cash, it's kind of doesn't make sense as such in a way. But as a residual, it may make sense. Like if bonds and equities are both showing up as extremely expensive, then you could interpret that as basically saying cash is cheap. And there are certain properties specific to cash that you can kind of look at, like positioning in cash. In the same way that we'd look at positioning in equities and bonds and other asset classes. So there's definitely that. I mean, there are some fundamentals for cash that we can look at, but then like looking at the actual return that you get or the expected real return, like, and you can kind of look at the curve and come up with an estimate of that. But, under most circumstances, it looks rubbish. And in the end, the purpose of cash is to basically protect capital and protect nominal capital. The expected real return might be negative for cash, it might be negative for bonds, but the your variance or the path of your nominal return is a little bit more straight line, at least for cash, versus potentially a very wiggly line for the others. So I think and if we were to look at hindsight, that situation where, like at least on my metrics, bonds and equities were both looking extreme expensive. Bonds are now looking neutral, but when they were both looking expensive, if you did take that interpretation that when those two are both expensive, then cash is cheap. That probably having a nice look in the rear view mirror, that would have been a pretty sensible approach.
The issue, of course, is that, to your point, right? It's a straight line. There's no variance with cash, so it works in an environment like this because everything else other than commodities, have been losing money. But when you do any kind of a historical rotation strategy or back test where cash is your expression of defense, you find that no matter what period you're looking at, cash for the most part doesn't work as the alternative assets because it's really not an asset to kind of your point. And that kind of goes to the studies around market timing. Market timing does not work because all the studies on market timing show that the risk off defense asset you time against is cash, the asset class or cash. Well, the problem with cash, of course, is that it has no momentum, right? So in an environment like this where most things have downward momentum, sure, cash is king, but the reality is historically you're better off having a chance, usually in defensive sectors, usually in long duration treasuries when you're in a highly volatile period, because at least you have the opportunity to potentially make money, even though obviously that's not been the case this year. So how should you think investors think about taking risk here when it seems like everything could be a landmine, right? So if you go into bonds, you've got the risk that yields keep spiking. You also have the risk, by the way, that yields spike not because of inflation, but because credit spreads blow out, which we'll talk about. If you go into stocks, well, there could still be another big, black swan, big decline to come. And if you go into commodities here, they're already so extended that, at least from a sequence of return perspective, you could get in and then face the immediate drawdown. Talk through how you think about that risk here in terms of putting some newer money to work at this juncture in the cycle.
I mean, the evidence seems to be stacking up that stocks are in a bear market. And so in terms of what to do with that, I guess it depends on what you're trying to do and what sort of time frame you're operating under. It would, you generally have a bearish bias, but, as I put in the latest chart storm just this weekend, shared a chart that showed a bunch of the bear market rallies during I think it was the 1930s bear market, and not saying that this is 1930s by any chance, but assuming that I'm correct there and that we are in a bear market, then from a trading standpoint, there are often some really deceiving and can be quite sharp rallies that will occur throughout the process. As you get these sort of attempts to try and find the bottom. I mean, in terms, I guess, quickly just on why I think that is the case. We always need to come back to the point that we're at pretty high starting point valuations, and so it was always basically at that point priced for perfection, and now we're basically moving into a lower growth period, certainly different from that reopening rebound. I count just about a dozen different leading indicators that are pointing to slow growth ahead. And so those are, for instance, monetary policy tightening, rising bond yields, rising mortgage rates, rising energy costs, and just plain loss of momentum, the tightening that we've seen in emerging markets. And that's pretty important because that flows through into earnings, and those have been pretty stellar run post pandemic in terms of earnings, and also just monetary policy, that the tide's going out there in terms of the liquidity. So I mean, it's almost the exact opposite of 2020. That now that there is this sort of global scramble to try and at least remove the stimulus, let alone try and tighten somewhat and try and get inflation under control. And those are pretty much the key drivers there. And then also technicals, they're basically breaking down, and it's sort of all relatively internally consistent. So I think I wouldn't be looking to try and catch the bottom in equities, at least until there's a lot of water to go under the bridge with this sort of process. You'd want to see valuations come down a lot more. You'd want to see the economy basically go down. So the PMIs, for instance, you'd want to see them go below 50 and then start to stabilize. You'd want to see central banks basically run their course in terms of the tightening, and tighten enough to break things fully, and then start into easing mode and positioning to be all washed out. But we're still early in the process and still waiting for we'll be waiting for quite some time, I think, before those conditions are met. In terms of bonds, I would be definitely looking at bonds for the bottom before equities. There's going to be probably, I'd say, a buying opportunity in treasuries, I'd say, and I'd say that globally, developed market treasuries, or the equivalent there, actually fell a lot more than US treasuries. And so that, obviously if you fall more, then it kind of gives you a bit more space on the upside. Emerging market treasuries, also US dollar terms, also looking pretty interesting at this point. And as I mentioned before, even US treasuries, on my valuation indicators, they're starting to show up as neutral / slightly cheap. I stress tested those models. They say, the time to sort of close your eyes and buy is 4.5%. The thing that would take us there would be just persistent inflation. And so, I think for bonds to bottom and have a, sustained bullish run, you need sort of a passing of the torch in terms of the drivers of bond prices at the moment, from inflation to economic activity. And for now, economic activity is still sort of puttering along. But if it follows the leading indicators down and we get a bit of a recession, a soft landing, a hard landing, whatever you want to call it, some actual slowdown in growth and a topping out in inflation, then that's kind of the key ingredients for some bond market improvement.
I used to call those periods the deflation pulse, right? That permeates when suddenly it's concerns about the economy slowing down and then yields dropping on the long end in advance in response to that anticipation. I used to call that often when I was writing for MarketWatch. And I want to take a second to talk about treasuries just from a personal and professional perspective, because this, again, has been such a very unusual period where treasuries have not acted like a safe haven asset. Now, if you did have, let's play this out. Let's say the historical behavior of treasuries comes back into play, meaning that long duration treasuries prices go up, yields start going down, and then equities start getting volatile. If you have anything like what you've seen in history, treasuries in those standard, let's call them risk off periods, it's not unusual to see them outperform equities by 3,000, 4,000, 5,000 basis points in a matter of weeks. And the best example of that is really 2011. And I'm referencing 2011 for a reason here, and I'm going to get to the question in a second, because in 2011, that's when S&P downgraded U.S. debt. And in August of 2011, you had the S&P drop something like 17% in a matter of weeks, while treasuries rallied, somewhere around 20 in a matter of weeks. So you're talking about, a near 4,000 basis point spread, literally in just a few weeks. You get that convexity with treasuries running. I'm curious if any of the work that you've done, if you see any parallels to what happened in 2011 in terms of credit downgrade risk and kind of the lead up to that summer crash of 2011 to what's happening now, because the more rates keep doing this and the more inflation keeps raging, I just don't see how you don't have some credit rating agency come out and make a statement on U.S. creditworthiness.
I mean, yeah, I guess at a high level, you might think, well, higher interest rates means higher interest cost for the US government, given that the borrowing amounts are not small. But I guess potentially, or at least partially offsetting that, is nominal growth is probably rising enough to kind of, well, I'd have to actually go and look at the math around that. But conceptually, if nominal growth goes up enough, then the nominal value of your tax receipts are going up. And so, in theory, there should be a little bit of offset there. And ultimately, that's kind of how or why bond yields went up in the first place, that whole sort of inflationary shock. But I think probably the credit space, well, corporate credit would be where I would potentially look for downgrades just as the economy worsens. But I think, we'd actually need to see the economic pulse really forthrightly turned down to see that. Looking across industry, CDS, one thing I did notice that was kind of interesting was bank CDS and technology sector CDS have been sort of just steadily working their way upwards. I mean, it's probably more to do with just the general environment of worsening investor sentiment and what's going on in equities, but I think that's definitely something to pay attention to. And I mean, if we look at IG credit, so investment grade credit, last I looked, it was about 50% triple Bs. So there is also the element of, the whole fallen angel aspect. Do you get away with downgrades that makes, that shunts a whole bunch of IG into HY space?
But to your point, it's like, okay, that's a good example. So in the case of my junk on, junk off strategy, it's based on the utilities trigger, goes back to the 1920s as a leading indicator of volatility in equities. When you have volatility in equities, credit spreads will tend to widen. So the whole idea of that strategy, right? And it's, there's an index that it tries to benchmark against. The whole idea is basically that it tries to avoid credit spreads widening. So you're in treasuries in advance of spreads widening. High yield becomes higher yield during that risk off event. And then hopefully not only have you avoided it, you've made money in treasuries at the same time, but then you go back into high yield at a higher yield. And guess what? When you have a year like this year where the entire bond market is shifting as opposed to yields rising necessarily because of spreads widening, again, you don't do all that well. But again, these periods are very, very abnormal. Now, that leads to a little bit of a discussion here around sentiment, because I see a lot of, I think, comments from people that are not understanding the way market dynamics work, are not understanding also the very fact that even though a signal may not work in the small sample of the here and now, that does not mean you should ignore the signal the next time it occurs. And I've used this line many times earlier last year that the level of uneducated speculation I was seeing in comments on Twitter and in the way people were framing things was astounding last year. And with hindsight, it was very clear, that was a sign that things were about to get very, very ugly. Talk about how do you not only think about sentiment from an asset allocation positioning standpoint, but how do you think about evaluating what sentiment is from various types of charts that you look at?
Yeah, and I guess just a passing comment there too on the so the new wave of speculation that kind of, or the new wave of speculators that came online is just like if you'd kind of educated your mental models or your mathematical models on the last 20 years, you'd be seriously wrong-footed if you developed your mental models of how markets work over the last 2 years. Then it's things work quite differently in a bear market than a bull market, especially the kind of raging and extremely unusual period that we just went through. But in terms of sentiment, in terms of like how you look at it, I mean, it's a big jungle really of different indicators there. Like there's the various weekly surveys, for instance, my one, which if you haven't voted in, go and vote in that. But there's a lot of different survey data out there. There's futures positioning, flows, positioning, leverage indicators, and they all kind of behave just a little bit differently, but the same basic principle is you look for extremes, and extremes will tell you the most information. I mean, like just stepping back for a minute and thinking conceptually about sentiment is basically your standard sentiment indicator is going to have momentum information through the range and contrarian information at extremes. And so if we think about the equity market, the stock market with like the sentiment surveys, as they are becoming more bullish, it's usually in line with the price, which is becoming more bullish. And then when they sort of reach a peak and turn down, that's when the sort of contrarian information starts to kick in. You often see a top around that kind of situation. So I think it's definitely useful, but then it's like I think the current environment is much like 2008, for instance, or the 2000s, where sentiment took a big lurch to the bearish side, and then you get these little rallies off the back of that, but sentiment can get to extremes and stay at extremes when you're having a trend change. So that's kind of the complicating factor there. It's definitely information in it, but it's also, it can be a little bit, I don't know if I'd say unreliable, but you have to kind of take it in context of all the other kind of background pieces of information as well. And then also, I guess, just looking at a specific chart from this week, I've shown there the surveyed measures of sentiment, which are, I think, something like 2 standard deviation low, or they've dropped to 2008 levels. Meanwhile, the surveys of positioning are showing that actually equity allocations went up a little bit in April, at least on the AAII survey. I guess, yeah, if your portfolio in that question that you're surveying is stock, bonds, cash, given that stocks and bonds are falling at the same time, then if you didn't do anything to your portfolio, then the equity allocation probably wouldn't have gone anywhere, or maybe you dumped to the bonds because you thought that they were going to fall even further. I think definitely is one of an indicator or a sort of a category of information that is worth factoring in, but I think it can be risky just to look at it by itself. I think there's some shorter term sentiment indicators that are quite good for trading, and then there's some sort of slower moving ones that are actually quite good for the longer term timing aspect. And actually, yeah, the last point to make, which I think is quite interesting, is that a lot of the information in sentiment versus positioning, but at least sentiment, can be explained by price. So a while ago, I had a look at those weekly surveys, the AAII Investors Intelligence, etc., and they, 90% of the movement in the surveys was explained by movement in the price. So, if you were doing things on a budget and you didn't get access to the various data on sentiment, you could just take price and do a couple of transformations on price. So, even just RSI or percentage of days positive, counts of different percentage movements, you could actually probably get most of the sentiment information in that. And there's kind of 2 reasons for that. Just quickly, is one is price heavily influences sentiment, but then also sentiment influences price.
Yeah, and it's interesting, right? Because the bulls would argue that sentiment surveys are so bombed out that they are a contrarian signal. But the problem is that if sentiment is following price and the sentiment is also following recency bias, right? Because people are used to, corrections or these types of declines, in the sort of 10-15% range. Well, then we don't really know what extreme negative sentiment is in the event that we're not in a normal correction, in the event that it is more like an '08 or a 2020 where it can go down quite a bit more, which we'll tease out for a bit. Okay, so we hit on several different areas. I'd be remiss if I didn't try to get your thoughts on food prices and agriculture, because this is what everybody's always talking about. You have a camp that is wildly bullish on the space, meaning expecting food prices to go even more vertical than they have. You have many that are also saying that, well, it's maybe too one-sided. There might be contrarian trade there, that food prices are not going to be as significant as one might expect. From the research that you've done, what's your take on where you think ag prices might be headed next?
Well, there's a couple of sort of background sort of features that I would kind of reflect on. So I was quite bullish on agris back in it was 2020, and the reason back then was, well, one of the key things that I was looking at then was you look at the capex conducted by food producers, like global food producers, and it was actually running at record lows, and that was also after an extended downtrend. And so, with any commodity, when the rate of capex is very low, you generally basically want to have a bullish bias. And it's actually the same story across commodities. And I mean, it was quite logical to expect that because agri-commodity prices, every commodity price actually, had spent about a decade doing pretty much nothing or going down. So that's starting to turn up, but it's still fairly low, at least last when I looked. The other thing back then, and this kind of changes, the Southern Oscillation Index, so basically indicator of whether you're in El Nino or La Nina, that had started to turn as well. And, it's it's a bit complicated because there's it's difficult to actually say, oh, this weather environment negative is going to send up agri prices, because you kind of get different effects around the world depending on which regime you're in. But the big swings or the really volatile kind of shifts are the thing to look for. So a really big shift in the Southern Oscillation Index, for instance, and to think about why, a big unexpected change in weather would arguably have the most impact. And then, of course, all that pandemic disruption that did occur. And at that time, sentiment positioning was kind of just starting to tick up. So it was the perfect storm back then to drive agri prices up. And then, of course, you got the geopolitical shock this year, which gave it an extra leg up. I would have thought that without that geopolitical shock, we'd probably be looking a bit toppy because, sentiment and positioning are fairly one-sided, and they still are quite bullish. And, kind of compounding on this situation has been the spike in input costs. But I think agri prices is where you tend to see the more resolute or the sharper, more rapid supply response, because you can kind of change crops or do things to increase yield versus planning a new mine and taking years to get a mine working, for instance, for base metals. So, I mean, I think we're probably a bit toppy for agri prices. And in terms of geopolitics, it's probably, I think the way I think about the geopolitical situation is kind of like COVID. It's not going to kind of get fixed overnight. Anything that's going to be kind of good is going to be quite slow to come about, and meanwhile it could get worse. So, I mean, given the way the sentiment positioning's set up at the moment, you could definitely argue that it's probably more easy for it to fall than it is for it to repeat what it just did.
Yeah, no, which kind of goes back to that point that there's so many landmines if you're trying to put some new money to work, because even though there's been a lot of momentum in the space, momentum crashes are a very well-known phenomenon if people will actually look up what that term is from a factor perspective. Now, I'm sharing in the space, Callum, the tweet you put out looking at how thematic strategies perform once there's an ETF launch in the theme. And I think this is an interesting thing to kind of talk about for a bit from the standpoint of the Bitcoin trade or investment as well. What does Wall Street do when it tries to come up with a new strategy or a new investment vehicle? It looks at whatever has performed the best over the last cycle, because the idea is that, well, people chase performance. So you want to launch something which is hot. But by the time they actually launch that product around that investment theme, it may already have be too late, right? And you can see that historically with a lot of different funds and themes. It's not unusual, right? Because this is what Wall Street does. It makes sense. Wall Street is not going to come out with a Bitcoin fund around the time when Bitcoin isn't having momentum. So let's talk about that for a moment, because I think this is interesting in terms of a lot of the excitement around the Bitcoin futures ETF that came out late last year. Bitcoin and other cryptocurrencies have really co-moved very heavily to the NASDAQ. Correlation has been quite high. And there was a lot of excitement that the institutionalization of Bitcoin would mean that Bitcoin would keep on going higher and higher. And it's been quite the opposite. Talk through how you think about the space and what you think people maybe get wrong when they frame that type of a narrative around cryptocurrencies.
Well, I think, just thinking about the emergence of new asset classes, even if you had forget cryptocurrencies for a minute, and if we had some imaginary new asset class popping up that was, maybe it's space mining or something like this, just some random asset class. It's even if it did go up over time, they're still going to have cycles. There's still going to be and there's going to be, well, especially if it's new and you have mass adoption, then you're going to have, extreme enthusiasm at the top, and which actually is its own worst enemy. I mean, there was lots and lots of people, at least over this corner of the world, and probably I'd imagine around the rest of the world, that were starting to put commodities into their allocations. At the height of the commodities boom, and it definitely wasn't a new asset class as such, but it was kind of being packaged as a bit of a new asset class, a new way to kind of improve risk-adjusted returns based on the historical data, which obviously had some positive skews to it. In terms of how I'm thinking about Bitcoin, I mean, as a disclaimer, I don't look, very closely at it, because most of my clients don't actually invest in it, or, well, they can't invest in it. But the way I think about it is basically liquidity drives it. So there's all these different things and bits and pieces around the margins, and over the long term, institutional uptake probably does help it go up. But like all assets, it goes through cycles, and those cycles are dictated by what's going on in the economy, what's going on in monetary policy. Just looking at what happened in 2020, 2021, the surge of liquidity, surge of central bank easing, the fiscal stimulus, that clearly gave a big boost to crypto, and everything really. Any sort of asset that is speculative or risk-seeking. And so now that those liquidity tides are going out, obviously we're starting to see that have a negative impact. So equities, Nasdaq in particular. And so I think that is that all kind of makes sense. And if we sort of assume that they were all kind of in the same basket, Nasdaq being quite expensive, the economic situation likely to turn down, at least the monetary policy definitely turning from tailwind to headwind. I wouldn't be expecting much good things to come from that space, or any risk asset really, in the immediate term.
Yeah, and I still think that there's a lot of uneducated speculation still going on there. And, I often rant about terminology like store of value, and I get some nonsensical response most of the time that only furthers my point. But I think the issue in this environment is that we're faced with a world where everyone is simply regurgitating these one-liners, whether it's in cryptocurrencies, Bitcoin, Tesla, yields, inflation, and people aren't really kind of taking the next step of going down the rabbit hole and asking more questions to see if what their initial thought actually is valid. So from that standpoint, again, going back to the way you look at markets and your own research, procedurally, Callum, how do you get out of the echo chambers that are naturally occur, right? When you're doing any kind of research, when you have a certain thesis, a certain belief, how do you try to, or what kinds of data sets do you look at to try to challenge your view? And maybe that's another side question, which is that what would be the thing that would maybe make you turn extremely bullish?
Well, the question there, or the answer there, is to look at the data. Look at the data, think, and be open-minded to changing your opinion as the data changes. For me, it's just keeping an eye on those charts, because at the end of the day, people have a lot of different opinions, and you can just end up following the noisiest person in the room versus taking a look at what the charts, what the data are actually telling you. It's that line. I tweeted out that video of Bertrand Russell the other day, but something he said reminded me of that old market aphorism: is that you have to trade what you see, not what you want to see. That means actually paying attention to what the data, what the charts are saying, and a bit less on, what you think should be going on, or even what anyone else think should be going on. But in terms of what I'd want to see to turn bullish, well, you basically need monetary policy to kind of come full circle. So, I mean, I think really the answer there is mostly time, because I think it's just going to take time before policy tightens enough to take the steam out of inflation, to damage the economy enough to either at least pause on tightening, let alone turn back to stimulus.
What would be your time frame for which you think that could be a possibility? And I'm saying that because I don't know, man. I mean, the more I look at liquidity draining as quickly as it has, even before the Fed started to raise rates, the more that I look at the devastation in terms of various asset classes, the overall market cap that's been lost, the market value that's been lost in bonds, what we've seen so far in stocks, it seems, and of course this horrendous mortgage rate spike. It seems to me like you could either be at the doorstep of a recession or in one now, which means by the way, inflation probably comes back down faster than people think, which means the Fed's not going to raise rates anywhere near as aggressively as is being talked about. What will be your time frame for you, how you think that full circle comes about?
Not to sound like a broken record, but I'd go back to the charts, the data, and let them kind of pave the way forward. So I kind of prefer not to try and project or make too many prognostications about the future, because it's easier to look at what the current situation is and base your opinion, your actions on that. But I mean, in terms of time frame, there's so many kind of ifs, buts, and variables in the way that it's kind of tricky to nail that down, really. I mean, in terms of the Fed potentially pausing, I mean, it comes back to, does inflation get out of control, or does it continue to spiral? Is there a point in equities down that they might consider financial conditions have tightened enough? An actual, the ISM going below 50. The thing to remember too, and I think probably a good sort of parting thought, is that the last couple of years have been very fast. And, some people described the 2020 March crash as a bear market, but I kind of push back and say that it was more of a crash. But even if we said it was a bear market, it happened really fast, and the rebound happened really fast as well. And 2008 was really fast, but 2000 was quite slow. It was a more prolonged, drawn-out process, and we've just been through a decade-plus long bull market, which has been a very long process. So I think open-mindedness is probably the key takeaway, and being open-minded that it may not be just a sharp down and up like we've kind of been conditioned to, that it may actually be the more prolonged, drawn-out thing with lots of ranging and ups and downs throughout.
Yeah, no, I think that's a valid way of framing it. So everybody here again, please make sure you follow Callum. I'm going to have this as a edited podcast on my YouTube channel. Hopefully things will be okay. I can tell you personally, it's been a very stressful period in my own life, my own career, and I know a lot of people are feeling that in different ways as well. So, as I always like to say, be kind, follow Callum, and enjoy the rest of your Sunday. Thank you, Callum. I really do appreciate it.
Yeah, thanks for having me. And absolutely. It's and I think too, on that note, it all sounds fairly pessimistic that what I've been saying, but it all goes in cycles, and on the other side of the bear market is another bull market.
Right, and it's true, absolutely. So, all right, very good, everybody. Thank you, Callum.